Hi from Madrid. Thank you very much for permitting us to be in Hacking Money. Let us present the world. We are two computer engineers specialized in finance in Madrid. And we have built an idea that is a decentralized dealer of last resort. It mainly is a crypto fund that tries to profit from this kind of spike movements that happens in crypto space. As we have seen, price discovery doesn't work very well in crypto. Market is not so efficient to address liquidity when we see irrational digital assets price. And that's mainly because liquidity is scarce, mainly in digital assets that are not well known, and it's not so much connected. And with volume, you can really put prices at levels that are very, very rational. And sometimes this returns very fast to the fundamental price. For sure, there will be prices that will be fundamental, but sometimes they are out of spike movements. And that's mainly because it's very cheap to move the price. So speculation profit from that environment. So liquidation happens sometimes where lending protocols have been liquidated. Even flash loans permit to have liquidity even for free. This price affects for non-experienced investors that sometimes sells in that kind of moments. And speculation strategies and also other structured agents that have commission for every trade, for sure profit from that volatility and high volume usually. Even we have the early initiatives that try to organize like this kind of capital in order to avoid irrational price, what occurs in the issuance of MakerDAO Foundation with the MakerDAO stock. So the world try to make profit from that kind of spikes, and in some way they try to make more expensive to move the price because it makes sense. That we would call last dealer resort. And we know that there are a lot of capital right now sitting on protocols like Compound, like Aave, that they don't want to take too much risk. They want to be too exposed to an interest rate. But probably if they believe in the project and they will be willing to take about a certain price, we will be probably willing to buy Ethereum at $8. That will define like this kind of ground and setting prices where we are going to buy and to sell in order to sell in this kind of extreme positions. We are going to do it in that way. A smart contract, we will have this investment in the traditional protocols of lending with low risk and very good interest rate, but we are going to put this liquidity in balance when we see an spike moment and to take profit in that moment that can put Ethereum to be at $8 or even, and after that to sell at $200. So in our demo, we have seen we have to duplicate an environment where we can really have this kind of simulations, and that's where we are right now, showing you that we have simulate. In that case, we have simulate an attack. The price with the attack, we will put the value probably 1980. We put liquidity in that moment, so we stop the price in 173, and even we put 90% of commission, so we profit a lot, and we really defend the price in that case. So really, the main conclusion with that is basically that it's possible to do a smart contract. The smart contract really can be mostly invested in interest rate in either compound without risk, but we can trigger in some way this liquidity to buy in some kind of moments, and with putting a commission of 9% in order to profit more from that moment that really doesn't care about the commission. So you can even to be more costly at commissions. So next steps will be to do it for different assets, not only to put that in a stop if you do buy and you don't want to sell, and to start a more efficient way to move liquidity from that. Thank you very much.